Today we're looking at 4 under-the-radar REITs to buy now. We're going to investigate each one of their historical performance. We'll look at their dividend safety, we'll look at some of their financial metrics, and as always, we'll run them through their valuation model to get to our intrinsic value, as well as our acceptable buy price given our investor margin of safety, and see what Wall Street are forecasting for the next 12 months. So the first under-the-radar REIT we will be analysing is Equinix. Now this is one that is up 16% over the last year. We can see over the last 10 years some strong performance, up 369%. It is currently trading in the midpoint of the 52-week range with a P to FFO of 31.71 and a yield of 2.13%. In terms of the dividend safety, well, we have a score of 86, making it very safe. Market cap 76 billion. It is a large cap company. Now when we take a look at the recessionary metrics, well, in the last recession 07-09 they paid no dividend, so we have no comparative data. However, they had plus 25% recession sales, well above the average of the S&P, which was around negative 12, but we do see a near S&P return, negative 56 versus the S&P's negative 55. Now, in terms of dividend growth, very strong, 25% last October. The last 5 years on average, double digits. We love to see that as dividend growth investors. And we can see it has increased the dividends over the last 8 years consecutively. Now, in terms of dividend yield theory, as always, it states a company is undervalued when the current yield sits above the 5-year average. So we have our sign of undervaluation, 2.13 versus 1.74, and we can see another sign here with the forward P to AFFO, 22.8 below the 5-year average. But remember, we don't look at any of these in isolation and will conclude towards the end. We note the real estate sector P to AFFO, however, is much lower at 13.7. Now with REITs, we do tend to look at the adjusted FFO, the funds from operation payout, as opposed to what we typically like to look at on the channel with the free cash flow. As for REITs, it is a lot more volatile. Below 90% as essentially the major blanket rule for the payout for REITs. We see for EQIX below 50% pretty much every single year. 2023, 45%, 2024 expected a little higher at 49%. So I would like to see nice double-digit dividend increases again this year for this REIT. In terms of the adjusted funds from operation, well, we see very nice growth consistently year on year. $32.10 in 2023, so we can see it has more than doubled over the last 10 years. 2024 expected more of the same with an increase of around 10%. Now, when we do take a look at this percentage-wise, pretty consistent over the last 10 years, very strong as well in my opinion. In fact, the last 4 years, 9%, 2024 expected again the same, is a very strong sign of any business. And we can see the sales growth of 5 to 10% year on year for that steady moderate growth being hit for the large part of the last 10 years, with the more recent period at 15%, a nice strong double-digit increase to their top line. And when we look at this numerically, we do see very strong, nearly 3 times growth over the last 10 years, more recent year at just under 8 billion reported. Now, as always with REITs, they will dilute your position as a shareholder over the majority of the period. As we see here, 52.4 million in 2014, 94 million in 2023. It is one of the REITs that doesn't really dilute your position as quickly as others, notably Realty Income and Vici Properties that we see on the channel. Nonetheless, it is something that you should be aware of as a shareholder or potential shareholder. ROIC then, an important metric in my opinion. You want to be looking for around 3 to 5% for real estate investment trusts. What we can see, one thing I would point out, it has started to decrease over the last 10 years. Now 3% is essentially the lower end of what I like to see. The fact that it has gone down to 2% in 2022, just something to keep an eye on in my opinion. Nonetheless, over the majority of the last 10 years, the metric does look reasonable. Operating margin, well, it has been decreasing over the last 10 years. Operational inefficiency, something again just to keep an eye on. At a bare minimum, I want to see 12%. They have hit that in 2023, but forward looking, I would like to see those margins go back up to what we saw between 2014 to 2018. Free cash flow margin, the opposite story. We actually see it increase over the longer term. That is very positive in a typical business, but remember that for REITs, it doesn't mean as much as it would for other companies. Net debt to EBITDA, then the earnings before the interest, tax, depreciation, amortization. We want to see below 5.5 for REITs. Remember, this correlates to the dividend safety as well as balance sheet strength. 3.83 in 2023, meaning the number of years it would take them to pay off all of their debt net of cash on hand. 2024 expected to go even lower, so this is very positive. This is a REIT that does have a very strong balance sheet, and in my opinion, the dividend, similar to the score, does look to be very safe. Now let's jump into the valuation for this company. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do run through all of these models. For today's episode, let's get straight into the final intrinsic value calculation, and we arrive at $920. Now with the current trading price at $793, we always start off with a margin of safety of 10%, and we execute on that if we believe it meets the three criteria: wide moat, strong financial metrics, good forward-looking data, and we keep going till it's near the current trading price. Now at a 15% margin of safety, it isn't quite there yet, but it isn't too far off. So for this REIT, which I do believe to be a high quality REIT, given the metrics that we saw, right now on the current value, you are looking at a 10 to 15% MOS level based on the estimates and judgments of today's episode. In terms of Wall Street, well, they believe the share price will go higher than our intrinsic value. They see upside of 20% and a price target of $950. So they do believe this is a very strong buy now. As always though, do let us know your thoughts in the comments with these REITs as we go along. Also, just to let you know, we have released our latest free weekly newsletter. If you want to gain access to this or any of the other articles, all completely free, do click on that pinned comment below. The next under the radar REIT we have is Digital Realty Trust. Now this is up 50% over the last year. We do see it in the mid to upper end of the 52-week range. And over the last 10 years, this has been up 159%. Bear in mind that doesn't include those dividends reinvested. And we see their all-time highs at $177 at the back end of 2021. They do offer a yield slightly higher than the previous REIT we analysed at 3.52% and the P to FFO forward of 20.8. Dividend safety, well, we have a safe score. We also see market cap of $43 billion, a large cap company. In terms of the recessionary metrics, well, they increased the dividend during the last recession. They had plus 21% recession sales, and they also significantly outperformed the S&P 500. Now, we are waiting on a dividend growth since 2022. Over the last 5 years, they have increased it in line with inflation at that 4% level, and over the last 10 years, around 5%. And we can see they have 0 years now of consecutive increases, although they have been paying a dividend for the last 19 years. In terms of dividend yield theory, well, we have a sense here of reasonable valuation, both on the yield as well as the forward P to AFFO. And when we compare it to the real estate, the sector P or P to AFFO, in fact, is much lower at just under 14. In terms of the adjusted funds from operation payout, well, remember below 90% for REITs, and we do see that every single year. 2024 is well expected to reduce down to 80%, so ideally we would like to see an increase to that dividend this year. In terms of the AFFO per share increase, well, it is very inconsistent. We don't see increases every year that we would typically see. Nonetheless, over the longer term, it has been increasing. 2024, they are expecting a nice increase to $6.11. Then when we take a look at this percentage-wise as well as the sales growth, we do see, in fact, over the last 10 years, 4 years of negative FFO per share growth. We do note, however, 2024, they are expecting an increase of 4%. And we can see their sales growth a little bit inconsistent, but over the longer term, they are hitting that as a minimum of 5 to 10%. 2023, nice double digits of 16%. And numerically, they have increased their top line from 1.6 billion to 5.5. Again, remember, they will dilute your position REITs, and we do see that with 134 million shares outstanding in 2014, with an increase to 309 in 2023. Now, in terms of the ROIC, similar to the previous REIT that we analysed, it is decreasing, in fact, 2% over the last 4 years. It is something I would just keep an eye on myself as a potential investor, or if you are an investor. So again, remember some metrics, not just to keep an eye on, but also factor in when we're looking at our margin of safety. Operating margin as well, we do see some operating inefficiencies. It is decreasing, but still above that minimum 12% that we want to see as a worst case scenario. Free cash flow margin, again, remember for REITs, are not very meaningful. In terms of the net debt to EBITDA, well, below 5.5 isn't really seen here across the board over the last 10 years. 5.87 2024, whilst it is expected to be lower, it is still straddling around that 5.5 level. Nonetheless, based on the metrics we have seen, the dividend does look to be safe, so no worries there, and the balance sheet does seem to be in order. Also, remember, if you want, you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio by clicking on that pinned comment below, or even if you want to look at other companies on your watch list. So a 10% margin of safety would be a buy at $150, so we can see it is a buy right now if you believe that to be applicable. At 15% at 142, and when we move to 20%, it isn't quite there yet, so we see a 15 to 20% MOS level for Digital Realty Trust. In terms of Wall Street, well, they do see upside, however 9%, they have a price forecast of $150 over the next 12 months. The next REIT that we are taking a look at is FRT, Federal Realty Investment Trust. This is up around 9% over the last 12 months. Over the last 10 years, however, you would be down around 13%, with the all-time high sitting around $170. Now, it is currently trading in the mid to upper end of the 52-week low, or range, in fact, with a forward yield of 4.38% and a P to FFO of just under 15. Now, dividend safety, we do get a safe score of 70. Market cap, just over $8 billion. It is a mid-cap company. And we know when we look at the recessionary data, they did increase the dividend during the last recession. Again, positive sales during this period, but essentially in terms of the recession return, negative 55%. Now, when we take a look at dividend growth, we can see very minimal growth, 0.9% in August 2023, 1% over the last 5 years on average, and as long as you've been holding it over the last 20 years, you would be getting an inflationary increase year on year. In terms of dividend growth streak, well, probably one of the first we have reviewed on the channel, with REITs being a dividend king, given they have increased the dividend over the last 56 years, whilst paying dividends for the last 62 years without a reduction. Now, in terms of that dividend yield theory, we do get a sense here of undervaluation, 4.4 above the 4.07 average, and we also see the forward P to FFO 18.7 below the 5-year average of 22.8, and we do still see it similar to the other two REITs above the sector P to AFFO. Now, when we analyse the payout ratio, we do note in the more recent year 88%. Whilst it is high and near that 90% maximum target, it is expected to drop in 2024 to 82%, which is positive to note. Then when we look at the adjusted FFO per share, we can see whilst it has increased over the last 10 years, we do note a lot of inconsistencies. Again, a more positive note, 2024 they are expecting an increase to $5.30. And when we take a look at the percentage-wise, we can see that whilst they have had some years of negative growth, they've also notably had around 4 years of double-digit growth to their adjusted funds from operation, and we don't currently have the data for 2022. In terms of the sales growth, well, 5 to 10% every single year. We do see that COVID year where it dropped to negative 11%, and in the more recent year of 5% towards the bottom of that 5 to 10% baseline level that we like to see. Now, in terms of shares outstanding, it is nice here now to note that they actually don't dilute your position as quickly as typical REITs do. They've only increased from 68 million in 2014 to 81 in 2023. Sales numerically is then, again, 690 million to 1.14 billion. Now, ROIC, a more positive outlook than the other two REITs in terms of the metric. We do see 5% over the last 2 years, and on average between 5 to 7% is a very healthy outlook for this real estate investment trust. Operating margin, whilst it has decreased over the last 10 years, we do see it pick up from the lows of 2020 to 35%, which is very healthy for this industry. Finally, when we take a look at the net debt to EBITDA, we do see it peak in 2020 to 6.9. It wasn't the greatest year for this REIT as we noted on the other metrics, but we note it has been coming down and 2024 is expected to be not too far off the maximum level, so no real worries there. Maybe something just to keep an eye on every quarter or every year, but overall no massive red flag on that metric. In terms of the valuation for this REIT, let's get to the intrinsic value, and we can see $108. Now, with the current trading price of $99 at a 10% margin of safety, we see it isn't too far off, so we do see near enough a 10% MOS level for Federal Realty Trust. In terms of Wall Street, well, they are very, very buoyant on this company. They see upside of 16% with a forecasted $115 price target. As always, let us know your thoughts on this REIT. It does look like they are signaling this as a strong buy now with their upside target. Finally, for those who like to see dividend yields very high, we have a DEA Easterly Government Properties with a yield of 9.38%. It is trading towards the lower end of the 52-week range and a P to FFO of under 10. Now, over the last year, it is down 10%, and over the last 10 years, in fact, we can see it did hit its all-time highs towards the 2020 point of around $30. Now, yes, it is in a downward trend, but this does offer a high yield, so let's find out whether or not this is a very strong yield supported by a nice dividend score. Well, we have a score of 40 unsafe, so let's take a look at that. Market cap 1.16 billion, a small cap company. In terms of the key metrics, well, we don't have that information available. In terms of the dividend growth, now 0% over the last 5 years as well. Something to bear in mind, whilst you are getting a very high yield of over 9%, bear in mind that the year-on-year increases aren't keeping up with inflation, and they have, however, been paying a dividend for the last 8 years without a reduction. Now, dividend yield theory, we do see that undervaluation signal on the yield. Very high, in fact, 9.3 versus their 5-year average. And the same can be said for the forward P to AFFO at 12. And this is now lower than the real estate sector at 13.7. In terms now of looking at their payout ratio, this is what we would say is a potential red flag indicator. This means that they have been paying out over 100% in dividends in terms of their adjusted funds from operation. Something that I would say to keep in mind that there could potentially be a dividend cut, given that it has been consecutively over 100%. 2024 expected again to be over that level. So this is something I would say to keep an eye on. In terms of adjusted FFO per share, well, it has increased over the long term, but we do see a lot of inconsistencies. 2024, it is expected to drop as well. And for those that like to see the percentages, we do see very inconsistent numbers, not only in the adjusted FFO per share growth, but also when looking at the sales growth, we want to see 5 to 10%, which we did see in the last 10 years, other than 2023, where we see a negative 1%. And numerically, we have seen it growing rapidly from 6 million in 2014 to 293 million in 2023. Now, shares outstanding, they have diluted very quickly, in my opinion, as we can see, but again, no real surprises there. One thing I would mention, though, just because we do see some metrics that are some red flag indicators, we could be looking at a very undervalued opportunity if there is a large margin of safety and upside as well. ROIC, nice to note, it has been increasing the last 3 years at 3%. At that minimum level, I do like to see for this industry. Operating margin has also been increasing, so actually one of the few today that has that operational efficiency. Mid-20s over the last few years, looking very healthy. And when we finally look at the net debt to EBITDA, we can gauge where that dividend safety score of 40 is coming from. It is very high, 7.52 in 2023. Now, nice to note it is coming down in 2024, although I would like to see this come down a lot quicker to be around that 5.5 level that as investors we do like to see. Now, in terms of the valuation, is there any scope for a large MOS level or upside? Our intrinsic value today for DEA comes to $12.83. Now, in terms of the current price at $11.38, we start off with that 10% margin of safety, and we can see around $11.55 it would be a buy. 15% not quite there yet, so we see between 10 to 15% and it's an MOS level. Again, it really comes down to the individual investor and what they're looking at. In terms of Wall Street and their price forecast, well, they are sensing around 14% upside. They have a price target of $13 over the next 12 months. Bear in mind, you are looking at a very high yield, so this could be attractive for an investor who is looking at a very nice yield over the next few years with some upside as well. As always, though, do let me know your thoughts in the comments below. As always then, if you have enjoyed the episode, smash that like button. If you do want to continually receive these videos straight to your doorstep, hit that subscribe and bell button. And as always, we'll see all of you on the next one.